Morning, everybody. Thanks for joining us this morning. My name's John. I'm the Managing Director of Investments and Capital at ESR Japan, joined by Chris Takahashi, Senior Director of Operations and Asset Management. And we're pleased to be here to give you an overview of the Japan business for ESR this morning. As an overview of what our footprint is in Japan, we are in an extremely high barrier of entry segment and a market leader in that segment. As of the end of December in 2022, we've had total assets under management of $11 billion. As mentioned, that encompasses about 4.7 million square meters of GFA and floor space, and that's either in existence or currently under development in Japan. These assets are primarily held across several flagship funds: the RGLF 3 Development Fund, the Japan Income Fund for core investors, with a parallel sister fund for domestic Japanese corporates, the ESR Private REIT, and several other major investment partnerships with large institutional investors such as AXA, M&G, Mubadala, and PGGM. In terms of how the portfolio has been performing, our occupancy levels remain extremely high, 91% as of the end of last year for all our properties. And within that portfolio, the assets that are over 2 years old and stabilized, we're at 99%. We are a vertically integrated team with strong in-house leasing and property management capabilities, and that means we lease most of our space directly, so as not to be dependent on third-party brokers. Over 70,000 square meters of space came up for renewal in 2022, and we're proud to say that we achieved, on average, an increase of about 13% in effective rents on that space. The team has and continues to raise a significant amount of capital for investment throughout Japan. And in conjunction with deploying that capital, we've also arranged over $2.3 billion of debt financing over the past few years. That consists of both non-recourse construction loans as well as permanent financing. As of today, ESR Japan has several active strategies with significant dry powder for acquisition. And on the development side, in order to consistently invest in institutional Japanese logistics at scale, you really need to have your own strong in-house development capability to be able to develop your own product. ESR has often led the country in annual warehouse construction starts, and we currently have 8 active projects under development at the moment. Our current portfolio of logistics consists entirely of facilities that ESR itself has built. One such project, the Sachira Park that you just saw a video on.
Thank you. So this is a project we saw in the video earlier. The ESR Yokohama Sachira Logistics Park is a 30-hectare site that ESR acquired in 2019 from Mitsubishi Heavy Industries through a closed bid, and we were selected after winning over our contenders. This is a multi-phase project which will have GFA of over 750,000 square meters. Only a handful of managers are financeable and will capitalize enough to take down a project of this size. We now have the 195,000 square meter ESR Sachira 1A that completed in 2022, with over 80% occupancy with tenants such as Nippon Express and Nitori. January saw the completion of ESR Sachira 1B, with multiple tenants in consideration for leases. Based on the strong demand of space in this area, the parcel 2A should start construction in the third quarter, with 2B to follow. With 2A and 2B combined, there will be 330,000 square meters of new space worth roughly $1 billion. A key theme that we'd like to highlight is that Japan continues to be a vibrant, opportunity-rich market, underpinning that Japan's enormous ongoing structural undersupply of large, modern logistic facilities. Japan continues to have shortages of modern logistics facilities, while at the same time there is much demand from the tenant for space. The illustration to the left shows that stock of modern logistics facilities is still very limited in the overall warehouse market. Only about 6% of the warehouses that exist in Japan are modern logistics facilities, while over 33% of the warehouses are over 40 years old with issues of seismic resistance. The remaining warehouses are small in size and many are inefficient. The graph on the right shows the number of small parcels deliveries by the main 3PLs. These are Yamato, Sagawa Express, and Japan Post. You can see that the numbers of small parcel deliveries have been increasing, and it has increased by more than 40% over the last 10 years. We expect this trend to continue, and therefore we expect to see strong demand for modern logistics facilities that has large floor plates that would allow efficient logistics operations. We also expect to see many firms to consolidate multiple operations to one facility, and in such cases, large logistics facilities will be necessary. Also, please note that estimated e-commerce penetration rate in Japan remains low at less than 99%, which is lower than other countries.
Thanks, Chris. The other point we'd like to convey is that despite increased uncertainty throughout the world, the Japan logistics space continues to be a bit of a bright spot. There is incredibly high investor demand for it. Large, stabilized portfolios rarely come out to open market, and when they do, they have shown to be highly liquid and continue to trade at tight cap rates. Two recent examples in the last 6 months or so are the sale of what in our view was a slightly under-rented portfolio by CBRE investors to Mapletree at what looked like a passing yield of about 3.5%, based on our analysis of the reported acquisition price of over 66 billion yen, roughly $500 million. Also just announced in the press was the sale of a Blackstone portfolio to GIC at what we understand to be a high 3% cap rate in a private negotiated deal worth over $800 million.
Another trend is rent growth. We have achieved it ourselves in Tokyo and Osaka over the last few years as leases began to roll over in our stabilized portfolio. And we've also seen it in the market with lease-up of newly completed developments. There is widespread expectation that this will continue in the major logistics markets, especially considering that recent cost inflation to build new facilities is only beginning to be passed on to end users.
Also, in stark contrast to many other markets at the moment, there is substantial positive yield spread. Japanese borrowing costs remain quite low, and banks maintain a very strong appetite for logistics amidst expectations that they are also going to see stable rent growth going forward. In terms of what's going on with monetary policy, just very briefly, the first Bank of Japan meeting under the new governor, Mr. Ueda, just took place. And coming out of that, there's no indication of any big impending changes in policy. The consensus view is that any base rate increases in the near term are expected to be very modest and gradual in pace. So what we're seeing on our own assets and projects are permanent financings that continue to be priced at margins of around 50 to 70 basis points, construction loans that can be secured at around 100 basis point margin in the range of 65 to 75% loan to cost. And we are seeing some increased lender selectivity bias towards larger transactions with well-established sponsors, but that neatly plays into our wheelhouse because that is more of a negative effect for newer market entrants with less track record. So on the whole, we view all these factors as potential net positives for the Japanese logistics investment case, and to no surprise, remain very optimistic about our own business going forward. In terms of key priorities for the business in 2023, firstly, we have always found great success in pursuing opportunities that pop up as a result of corporate restructurings. As such, we'll continue to pursue those wherever we can find them. And whether that involves an outright sale of non-core assets or operational sale-leasebacks. Good past examples of how we've capitalized on these opportunities include the Sachira project, which itself was a corporate non-core asset disposal. And there's also our newly completed Higashi Ogishima facility, which started off as a long-term operational sale-leaseback to Mitsubishi Fuso until we were finally able to negotiate them out of that lease and redevelop the site.
Okay. A key strategic focus is the acquisition of large-scale land that requires rezoning. Although this takes longer lead time to start construction, it allows ESR to secure land in good strategic locations below market while avoiding bids. ESR has a team dedicated to urban planning, and we have an established track record on developing several projects that require rezoning. For ESR Kuki DC to the left, this was originally zoned for school and was owned by Tokyo University of Science. After working with the Kuki local government, we rezoned the land into an industrial zoned area and developed a 151,000 square meter logistics facility anchored by Amazon and Nippon Express. More recently, the project in the middle, the one in the Osaka region, the Kawanishi project that will be in 2 phases with total land size of 90 hectares, was originally a land zone for residential development. We've worked very closely with the Kawanishi government on this and rezoned the land into an industrial zone area, and the first 2 buildings of Phase 1 will start construction this summer. With Phase 1 and Phase 2 combined, 690,000 square meters of new space will be constructed, which is worth $1.5 billion. The last example of our rezoning project to the right is Kuki Shobu. The land is strategically located in the northern area of Greater Tokyo, where 2 major expressways, Kengo and Tohoku expressways, intersect. In this case, we are working to put together over 100 agricultural land held by different landowners. The rezoning process has begun, and it will be rezoned by 2024. And we will start construction of a 2-phase project with total GFA of 245,000 square meters. Part of what separates ESR Japan business from most of its competitors is that we have a very strong in-house leasing and property management team that has been doing phenomenal work over the past few years. The leasing activity in Japan remains very strong, and we expect to have approximately 500,000 square meters to be leased this year. Roughly 80% of our leases have historically been originated directly, and so we are not dependent on third-party brokers. ESR Japan has over 85 tenants as customers, including Amazon, Nitori, Senko, Sagawa Express, and other major 3PLs.
So with all that in mind, one new area of increased focus for us in the coming year will be to leverage off of those capabilities and market knowledge to explore forward commitment purchases of newly built facilities from other developers. And that's a very big potential opportunity. In recent years, competition to acquire sites at public auction has become much more fierce. And frankly, at times we've been left scratching our heads about how winning bidders were able to justify their pricing based on our own view of rents and construction cost. We suspect there may have been some miscalculations made by firms with less logistics experience, because now we are beginning to see more of a high volume of potential forward commitment deals from third parties who are looking to exit their developments immediately upon completion, perhaps to salvage target investment IRRs, and or just no longer comfortable with taking 100% of the lease-up risk themselves and being reliant on third parties to get them there. Whereas we are comfortable with leasing risk, we have our own views, and right now we've already seen roughly 80 billion yen worth of these deals, and view that there's going to be less competition for them. So the additional deal flow is nice. It's adding to an already large development deal pipeline in Japan. And in aggregate, combining everything together that we're currently looking and examining in the potential deal realm, there's well worth of over future $6 billion worth of assets and opportunities under review.
Again, in keeping with a leasing-focused theme, another key priority this year is an increased asset management focus on driving rent growth from within our existing assets. We are putting much effort in trying to negotiate with our tenants to include rental escalation clauses in our leases and increase the rents upon renewals. In 2021 and 2022, we average between 10 to 13% increase of effective rents on renewals each year. We expect to be able to achieve the same levels this year also.
Other areas of focus for us include continued execution of future capital recycling. That's both by moving assets on the balance sheet land bank into development funds and moving now stabilized assets out of development funds and into ESR-sponsored core vehicles wherever possible. We are also working on new private fund products, such as the next RGLF series flagship development fund for Japan, and also exploring other complementary offerings that may be focused on value add and urban industrial strategies. We will also be continuing to explore the eventual transformation of our Japanese private REIT into a larger public one for future listing on the Tokyo Stock Exchange. So to summarize this brief look at our business in Japan, we'd like to again highlight our view that even with so much uncertainty going on elsewhere in the world, Japan continues to be a very vibrant logistics market with ample opportunity and liquidity. We view the ESR platform as being very well positioned to access all those opportunities. We have an extremely deep, experienced team in all areas of the business on the ground in Tokyo, Osaka, and in Singapore, with many of us in senior leadership having worked together and/or under Stewart going back 20 years now through previous companies prior to ESR. So in terms of some final key messages and key takeaways we'd like to express on to you today. First, again, Japan is a great, wonderful, vibrant logistics market. Our ESR platform there is not something that is easily duplicated or replicated. We've built this Japan business over the past 10 to 20 years, if you go back that far, largely through developing our own facilities. And what we do develop is best in class. We have a focus on future-proof product that's going to fit the growing needs of increasingly e-commerce focused tenants. And thank you very much. We'll turn it back over for some Q&A.
Thank you, John, and thank you, Chris. Good morning, everyone here with us at Suntec, and also most of you who are joining us via the webcast. Very good morning. I'm Marilyn, and I'll be the Q&A moderator for today. I'm also the timekeeper for today, so I'll try my best to go through all the questions that you've submitted. But I think given the time that we have right now, we have only time for 2 questions. So the first question to John and to Chris, what is your view on the cap rates for Japan?
Our view on cap rates at the moment and in the near foreseeable future is that they'll remain steady and tight. I touched on it very briefly in part of the presentation, but historically, much of the institutional supply has been built and kept in individual investor ecosystems, like ESR tries to do in developing its own assets to put into its own funds. And so what we're seeing is whenever a stabilized portfolio comes onto the market, it's relatively rare, becoming more common, and those do tend to trade at pretty good cap rates without evidence of any impending expansion. Those 2 examples that I cited earlier in the presentation probably being the best recent evidence in the last 6 months.
Okay, thank you for that. We have the second question here, which is Prologis indicated in their investor calls that they are projecting vacancy in Japan to increase to over 10%. And do you see evidence of this trend for our portfolio?
Take this.
Sure, go ahead.
Yes, we do see vacancies in some areas, but I think it really is areas in the northeast side of Tokyo near Kingo Express, where locations are not very good, for example. And some asset managers, developers, they did make some warehouses that are not in the right locations, and the size is not right, or the specifications are not right, or the rents were not set. But when we build, we talk very closely with our leasing team, construction team, and we put the right specifications and the right rents. meaning we really do due diligence on the location, and depending on the locations, the cargo is very different. So we'll see if it's going to be suitable for a warehouse that you take out and cargo really quickly, or it's kind of area where you will keep the cargo for a long time. So it really depends on the area. So if you're in the right location, the right place, and if you set the right specifications, I think you'll be okay. And I think our facilities, we've set it and we acquired in the right location. And we're seeing good traction with our warehouses in Tokyo area and other areas. In fact, we'll see one of our warehouses in Tokyo Bay Area to be at least 100% soon. And we're seeing a lot of traction in the ones in the Yokohama region also. We do see some asset managers, developers being a little bit cautious now. They want to see how the vacancy will go, and they're also seeing how the construction costs will be like. But because we have a good leasing team and a lot of intel, we feel comfortable building now if it's the right location and if we can acquire it at the right place, especially using the rezoning strategy. If people are going to be cautious now, in 2-3 years, there's going to be less supply. So I think we'll have a good room for negotiation then.
Yeah, and whether 10% is the upcoming number, I'm not familiar exactly with the Prologis details of how they projected that. But suffice to say, we go back to the underlying fundamentals of the huge undersupply of modern logistics in Japan. So while we may see some upcoming spikes in the key markets over the next couple of years of new supply coming on, we do expect that all to be absorbed.
Okay, thank you. I think we have time for just one more question. Why does ESR Japan focus on large projects, including rezoning projects?
I take this
Yeah.
one. All right. If the project is large and sizable, a lot of competitors would shy away. If it's about 10,000 square meters or 20,000 square meters in size, there'll be like 30, 40 competitors in a bid. But if it's over 50,000 square meters or even larger, there aren't that many competitors. It'll be probably us and maybe just one or two more. And we're very good at it. We've done Amagasaki, that was 380,000 square meters in Osaka. It's one of the largest warehouses in Asia. Sachiura that we talked about earlier, 30 hectares. We've done it creatively to make it into phases. And we're very good at it. We have track record, and financiers are very happy to lend to us on those projects also. And these rezoning projects also help us. We can get land in a good strategic location, and we can avoid bids. This is really important, avoiding bids. And we can get the land at below market, and we want to continue doing this because we have a team dedicated to urban planning, and we can handle these type of deals.
Okay, perfect. On the clock. Thank you very much, gentlemen.
Thanks, everyone.